You told yourself you'd start investing when you had more money. Makes sense. Except it's the most expensive decision you'll ever make. Here's the proof. Two people. Same $200 a month. Same market. Same 8% return. Person A starts at 22, invests $200 a month, stops completely at 32, never invests another dollar. Person B starts at 32, invests $200 a month, never stops, keeps going for 33 years straight. At 65, who has more? Person A, $508,000. Person B, $386,000. Person A invested $24,000 total. Person B invested $79,000 total. 3 times more money invested. Still lost by $121,000. That's not luck. That's compound interest. And time is the only input you can never buy back. Let's break down exactly why this happens. Compound interest means your returns earn returns. Year 1, you invest $200. It earns 8%. You have $216. Year 2, that $216 earns 8%. You have $233.28. The extra $1.28 came from interest on interest. That sounds tiny. Over 43 years, it's everything. At 8%, money doubles every 9 years. That's the rule of 72. Divide 72 by your return rate. At 8%, 9 years. Person A invests $200 a month from 22 to 32. 10 years. At the end, they have a lump sum of $36,589. Then they stop completely. But that $36,000 keeps doubling every 9 years, with no new money added. At 41, $73,000. At 50, $146,000. At 59, $292,000. At 65, $508,000. From money they invested over a decade in their 20s, without adding a single dollar after 32. Person B starts at 32. Same $200 a month. But their money only gets 33 years to compound, not 43. They lose one full doubling cycle. That one cycle is worth more than 33 years of contributions. This is why time beats amount. Always. Let's go deeper on the numbers. Person A, $200 a month, age 22 to 32, 8% annual return. Stops completely at 32. Total invested, $24,000. At 65, $508,260. Every dollar they invested returned $21.20. Person B, $200 a month. Age 32 to 65. Same 8% return. Invests for 33 years straight. Total invested, $79,200. At 65, $386,729. Every dollar they invested returned $4.90. Same market, same rate. A fourfold difference in efficiency. The only variable, when they started. Now let's add Person C. Person C starts at 22 and never stops. $200 a month, age 22 to 65. At 65, $894,989. Nearly $900,000 from $200 a month. The difference between A and C is $386,000. That's the cost of stopping at 32. And the difference between B and C, someone who started 10 years later with the same amount, is $508,000. Starting early and staying in. That's the entire mechanic. I'll start when I have more money. That sentence has a hidden assumption. That more money later equals more wealth. The math just proved it doesn't. Person B invested 3 times more than Person A and still lost by $121,000. More money later is worth less than less money now, because time is the multiplier, not the amount. Here's what $50 a month looks like starting at 22. At 8%, at 65. $127,000. The same $50 a month starting at 32, $96,000. $50. Less than a streaming subscription and a couple of coffees a week. The financial system profits from you waiting. Every year you delay, your money works for a bank at near zero interest instead of compounding in your favor. Savings accounts pay 4 to 5% at best right now. Inflation runs 3 to 4. Your real return in a savings account, near zero. The S&P 500 has averaged over 10% annually for the last 30 years. After inflation, around 7 to 8% real return. That's the difference between your money compounding or evaporating in slow motion. You cannot buy back time. You can always earn more money. You cannot earn more time. That asymmetry is the entire mechanic, and nobody teaches it at 22. They teach you to save, to be responsible, to wait until you're ready. That advice costs hundreds of thousands of dollars. The market doesn't wait for ready. Here's what you actually do. Step 1. Start with whatever you have. Today. Not next month. Not when you get a raise. Today. $25, $50, $200. The amount is not the variable. The date you start is the variable. Step 2. Use index funds, not stock picking. A low-cost index fund tracks the entire market. No research, no timing, no guessing which company wins. Over 20 years, 90% of actively managed funds underperform the index. The experts lose. The index wins. Use the index. Step 3. Automate it. Set a recurring transfer on the same day as your paycheck. Before you spend on anything else, pay yourself first. The investment leaves the account before you see it. Every other expense comes after. Step 4. Don't touch it. The market will drop. It always drops. Every crash in history has recovered. Every single one. Selling during a crash converts a temporary loss into a permanent one. Don't sell. Don't panic. Don't check it daily. Let the compounding run. Here's what you leave with today. Time is the multiplier. Amount is secondary. $200 a month from 22 to 32 beats $200 a month from 32 to 65 by $121,000. With 3 times less money invested. You don't need more money to start. You need to start. If this changed how you see time and money, subscribe. One financial mechanic every week. The ones most people learn 20 years too late.